Well, thank you very much, Gordon. That's a wonderful welcome. I am absolutely delighted to be back in front of the Empire Club for the second time. And yes, I am a grandfather. It's just, things happen. But I'm wearing 1955 penny cufflinks, not by accident. So anyway, enough of that. It's been over 12 years since I was last here in 2003. And at that time, I was speaking about how Canada could succeed in an uncertain world. It actually sounds like a speech I could give again today. 2003 was a vintage year here at the Empire Club. It was your centennial. And several speeches that year still sound topical today. In fact, Ann Curran was the president at that time. And it's nice to have you here today, too, Ann. But the speeches from 2003. Gary Bettman was here to talk about the NHL and the future of hockey in Canada. Former Prime Minister Viktor Yushchenko spoke about what was going on in Ukraine. And here's my best one. Ralph Klein, the Premier of Alberta, gave a speech entitled, "A Made in Canada Approach to Global Warming." So the more things change, right? So anyway, this is a good reminder that past experience can help us understand today's issues. And currently, economists are debating why there's been such a persistently weak expansion in the world's developed economies. Is this long period of slow growth a cyclical phenomenon, or is it something permanent? Well, a prominent Harvard University economics professor has suggested that the U.S. economy was headed for what he called secular stagnation. Extended periods of strong economic growth were no longer likely, he said, because of a chronic shortfall in demand. Now, I know what you're thinking, but I'm not referring to Harvard's Professor Lawrence Summers, who holds this secular stagnation view today. I'm talking about Professor Alvin Hansen, who coined the phrase secular stagnation in 1938 during the Great Depression. Now, of course, soon after Hansen published this view, U.S. economic growth took off amid a burst of spending. Of course, as we know, it was tied to war. Stagnation, though, did not return after the war ended. Instead, the U.S. experienced one of the strongest and longest-lasting expansions on record. So what happened? Well, Hansen's population assumptions changed. For one thing, the post-war period saw increased immigration and, of course, the well-known baby boom. And technological advances, which he had been concerned about, actually helped to boost productivity growth much more than expected. But an important ingredient was the revival of what John Maynard Keynes famously described as animal spirits. So during the Depression, consumer and business pessimism was pervasive. And once confidence revived, pent-up demand was unleashed and self-sustaining growth returned. Well, this bit of history should help us understand the global situation today. Many countries, including Canada, are again facing the sort of demographic challenges that Hansen saw in the 1930s. And many would argue that technological advances are much less likely to fuel steady growth, as they did in the 1950s and the 1960s. Larry Summers and other secular stagnation supporters argue that the level of interest rates needed to bring the economy back to full capacity is below the effective lower bound for monetary policy. In other words, they say that central banks are powerless to stimulate enough demand to use up excess supply. Now, others, including me, would disagree. It's true that demographic forces are leading to slower growth in the labor force. The baby boom is over. But this reduces the natural rate of interest in the economy, and it increases the chances that monetary policy will at some point be constrained by the lower bound on interest rates. But recovering from a shock like the global financial crisis can be a long, drawn-out process, just as it was in the 1930s, as consumers and businesses repair their balance sheets and rebuild their confidence in the future. Now, ultimately, I see this as a cyclical issue, not a secular one. although, of course, the cycle is proving to be longer than usual. But more to the point, I take issue with the word stagnation. Stagnation. The world's policymakers put in place measures to mitigate the damage of the crisis and to prevent the worst. We've strengthened our financial architecture to protect against future crises, and that system is still adjusting to those. Growth has been slow, but it has not been non-existent. Many of those policies remain in place, sustaining growth and avoiding stagnation, and will do so until such time as Keynes' animal spirits, which were crushed over the past 7 years, revive. So no matter where you stand on this issue, though, it's clear that the expansion in the developed world is slower now than it was in previous decades, and it probably will remain that way. And this is because population growth is slowing as the positive impact of the post-war baby boom is mostly behind us. But economic progress can still come through productivity-enhancing technologies, which historically have defied prediction. And there's a plethora of structural policies that can raise trend economic growth, such as trade liberalization or labor market reforms, which are being actively discussed at the international level by the G20. Now, in the bank's last monetary policy report, just in October, we forecast that the Canadian economy would return to positive growth in the second half of this year, and that annual growth would continue to increase in 2016 and 2017. And that would see our economy use up its excess capacity and return inflation sustainably to the 2% target around mid-2017. And so far, that forecast seems to be playing out, as we said in our interest rate announcement just last week. Now, beneath the surface, however, our economy faces a complex and lengthy adjustment to lower resource prices, an adjustment that will unfold over the next several years. And while the resource economy works through this adjustment, the non-resource economy should continue to gather momentum, driven by improved export performance. And this, in turn, would be followed by rising investment, growth in the population of companies, and a steadier trend in new job creation. This adjustment process is being facilitated by the strengthening U.S. economy and, of course, a lower Canadian dollar and low interest rates. Now, when we put out a forecast, the risks around that forecast are evident, and we believe they're roughly balanced, which is to say that there are things that could still disappoint us, but there are other things that could surprise us on the upside. Now, on the downside, weakness in emerging markets such as Brazil and China could turn out to be more pronounced than we expect, or commodity prices could fall further as new supply weighs on prices. On the upside, though, it's possible that as momentum builds, consumer and business confidence will see a synchronized upturn, not just in Canada, but in the U.S., adding more momentum to growth. And this is the factor that's very important to economic cycles, as it was in the recovery from the Great Depression, yet inherently cannot be forecast. Now, there are many such elements of uncertainty in the process of making monetary policy. And that's why the bank has characterized its decision-making process as one of risk management, not engineering. Now, we go on beyond determining the most likely outcome for the economy. We also identify the major risks that we face in either direction. And then we think about how we would react if some of those risks were to materialize. In short, we're paid to worry and to be prepared. And I think that's just prudent policy making. So I think it's fair to ask what we would do in the unlikely event that the economy was hit with another major negative shock, one that significantly threw off our projection. And with the economy already exhibiting slow growth and interest rates already very low, there would appear to be very little room to maneuver. Indeed, the bank's policy rate today is 0.5%, just a quarter point above the record low set back in 2009. And that was a dark time for the global economy. Now, back then, at the height of the financial crisis, we believed that our key rate was at its effective lower bound of 0.25%, that we would need other tools in order to provide any additional monetary stimulus. As a result, the bank spelled out how it would conduct unconventional policies in an annex to our April 2009 Monetary Policy Report. Well, since then, we've reflected on this through our experience, and we've seen how other central banks have conducted their own unconventional policies. And we've updated that document, and we're publishing it on our website today. So I'm going to elaborate on some of these policies, but before I do, I need to be absolutely clear about two things. First, today's remarks should in no way be taken as a sign that we're planning to embark on these policies. To reiterate, our base case sees the Canadian economy returning to full capacity around mid-2017, and the risks to the outlook are roughly balanced. We don't need unconventional policies now, and we don't expect to use them. But, as I said, it's prudent to be prepared for every eventuality. This is a key point, so please let me repeat it in French. Nous n'avons pas besoin de politiques non traditionnelles actuellement, et nous prévoyons pas devoir les utiliser. Toutefois, c'est faire preuve de prudence que d'être prêt à toute éventualité. The second thing I want to stress is that the framework that we're publishing today certainly won't be the last word on unconventional policies. The post-crisis adjustment process is still unfolding, and central banks continue to learn lessons from that experience. Best practices will continue to evolve. So what is in the central bank's toolkit when interest rates are already very low? Well, let me just remind you of a couple of key principles around the use of unconventional policies. These haven't changed since 2009. The first is this: regardless of the situation, the bank will keep its primary focus, its primary mission will be to achieve its inflation target. Also, because we want our policies to be as effective as possible, we concentrate the use of these tools in specific sectors or markets while aiming to minimize any unnecessary market distortions. And finally, we conduct operations carefully in order to minimize the risk to our own balance sheet. Well, the first tool in the toolkit is one that many have used to good effect, and that's what we call forward guidance. By forward guidance, I mean more than simple boilerplate language the central bank might use to indicate the expected direction of the next interest rate move. I'm referring to statements such as the conditional commitment that we made in 2009. That's when we pledged to keep the key policy rate unchanged for a year, as long as the outlook for inflation didn't change. Well, forward guidance can lower longer-term interest rates by signaling to investors that the policy rate will stay at a given level longer than they previously expected. It also provides more certainty about the path for short-term interest rates, reducing the risk premium that's built in to longer-term rates. So by lowering the entire yield curve, the policy action affects a wider range of borrowers, boosting the demand in the economy and leading to a higher output and inflation. Now, for forward guidance to be most effective, it has to be credible. When we made our conditional commitment, both words were important: conditional and commitment. And we backed our commitment by offering term financing to the market at the overnight rate for the entire period. And we repeatedly stressed that the pledge was conditional on the inflation outlook. And as it turned out, we raised interest rates weeks before the commitment expired because we saw signs that inflation was returning to its target more rapidly than we'd expected. So that conditionality demonstrates that the inflation target remains the bank's primary mission. Now, as I've said before, forward guidance also comes with costs. It distorts the market's processing of new information. It takes specific types of uncertainty off the table. And this concentrates the market's position on one side of the distribution of possible outcomes. Exiting from forward guidance restores two-way trading, and it restores the market's ability to absorb economic and financial volatility, which is natural. Now, a second tool that the bank outlined in 2009, which has never been used, is large-scale asset purchases. Now, I emphasize the term large-scale because the central bank engages in asset purchases in the normal course of its business. That's how the central bank balance sheet grows along with the economy and allows us to distribute a growing stock of banknotes into circulation. But large-scale asset purchases, or often referred to as quantitative easing, entails the central bank creating large amounts of new reserves and using them to purchase large quantities of securities, such as government bonds or private assets, including mortgage-backed securities, corporate bonds from the private sector. Now, those kinds of purchases can have three effects. First, they create new liquidity in the banking system, which can increase the availability of credit if the system is tightened, allowing firms and households to continue to make buying decisions and supporting economic growth. But secondly, large-scale asset purchases tend to lower the interest rates on the purchased assets and on other types of debt that are of similar duration. In effect, as before, that flattens the yield curve, brings longer-term interest rates down closer to short-term rates, and so, as with forward guidance, this can enhance the impact of policy, spreading it out to a wider range of borrowers and thereby boost economic growth. At the same time, higher asset prices from these purchases can create a wealth effect, which can also boost spending and confidence. The third effect is that these purchases of assets tend to put downward pressure on the exchange rate. And this is because they reinforce market expectations of a lower profile for interest rates for a longer period. Now, this can boost aggregate demand further through increased export sales, or, more simply, because existing export sales produce more revenue measured in domestic currency. Now, all of this can happen while the central bank's policy rate is unchanged. Now, several major central banks have deployed this tool since the crisis. This includes the U.S. Federal Reserve, the Bank of England, the European Central Bank, and the Bank of Japan. Now, their experience shows that this tool can be effective in extending the central bank's impact well out on the yield curve. So a third unconventional monetary policy tool that's been developed since 2009 is called funding for credit. And the idea here is to make sure that economically important sectors continue to have access to funding even when the supply of credit might be impaired. In this case, the central bank would provide collateralized funding at a subsidized rate as long as banks met specified lending objectives. So the Bank of England and the UK Treasury set up a program like this in 2012. And it was designed to encourage lending to households and businesses at a time when banks were facing increasing funding costs. And that, of course, meant that borrowers weren't getting the full benefit of low policy rates. Now, while the Bank of Canada has never engaged in funding for credit, at the height of the crisis, the government did put in place the Insured Mortgage Purchase Program. And under this program, CMHC bought insured mortgages from lenders, which made room on their balance sheets for new mortgage lending. So this program was clearly aimed at one market segment that was at risk of impairment in the crisis, and so had a similar purpose to funding for credit. The fourth unconventional monetary policy tool, and the last one that I want to cover, is negative interest rates, which is something you've heard a lot more about recently. Now, back in 2009, the bank said it couldn't cut its policy rate below 0.25% because we believed that zero or negative rates might be incompatible with some markets, such as money market funds, for example. This was a common view at the time. But since then, we've seen the experience of several central banks, such as the ECB and the Swiss National Bank, which have adopted negative policy rates. There we've seen that financial markets have been able to adapt and continue to function. Now, given these and other developments, the bank is now confident that Canadian financial markets could also function in a negative interest rate environment. Pour souligner, au vu de ce constat et d'autres évolutions, la Banque est maintenant convaincue que les marchés financiers canadiens pourraient fonctionner avec les taux d'intérêt négatifs. Now, let me pause at this point to answer an obvious question. Why would anybody ever accept a negative nominal rate of return when they could always just hold cash and earn a zero return? Now, a big part of the answer is that there are costs to holding currency, especially if you have a lot. And these costs affect that lower bound. Because of the costs, they would include things like storage costs, insurance costs, security costs. Central banks can charge negative rates on commercial bank deposits without seeing a surge in the demand for banknotes. Now, last month, the bank published a staff paper that analyzes those costs here in Canada and the convenience benefits of electronic payments in a number of other countries. It reflects on that experience that other countries have seen. Now, another staff note on the determinants of the effective lower bound in Canada is being released today. And we now believe that the effective lower bound for Canada's policy rate is around minus 0.5%. But it could be a little higher or a little lower. But this suggests that we have more room to maneuver in response to adverse shocks than we believed back in 2009. And we'll continue to watch the experience of these other countries. The Swiss policy rate, for example, today is minus 0.75%. And we'll also consider what adjustments might need to be made to the bank's operational framework, should they ever be required. But to sum up, once interest rates reach very low levels, the central bank still has meaningful tools that it can deploy in its pursuit of its inflation target, offering forward guidance to financial markets, large-scale asset purchases, funding for credit, and pushing short-term interest rates below zero. Now, there's a few other lessons that we've learned about unconventional monetary policies in the past few years, and I just want to touch on a couple. One lesson concerns when to use which tool. When we published our unconventional policy framework in 2009, there was an implied sequence to the various measures. Forward guidance was tried first, with quantitative easing and other measures held back in reserve in case forward guidance proved to be insufficient. But what we've learned since is that there shouldn't be a predetermined order. The effectiveness of each tool will depend on the situation, making it more a matter of choosing the right one at the right time. Furthermore, the various measures can be mutually reinforcing when used in combination, so it makes little sense to commit to a particular sequence for using them. Another lesson we've learned from the global experience is that while unconventional monetary policies can help stimulate the economy, there may be limits to their impact. Take negative interest rates, for instance. While we now believe that interest rates can be pushed below zero, there still is a lower bound. So we can't be cavalier about how much room to maneuver we have. Further, there's evidence that consumers and businesses respond less to interest rate declines when interest rates are already very low. And there's evidence that the responsiveness is also lower when confidence is low and when they're trying to reduce debt. I expect that few of us find these things surprising. But at the same time, it's fair to say that the limits of large-scale asset purchases are still being tested. So our understanding of this tool will continue to grow as we watch it being used in other economies. And that, of course, includes the eventual conclusion of those and the exit from their programs. But fundamentally, economists have long been aware that the effectiveness of monetary policy has its limits once interest rates reach very low levels. Keynes himself noted as he watched the Great Depression unfold that fiscal policy tends to be a more powerful tool than monetary policy in such extreme circumstances. Now, it may sound ironic, but the circumstances under which it may be appropriate to consider unconventional monetary policies are also those under which fiscal policy tends to be the most effective. But even so, it is worth knowing that monetary policy can still make a meaningful contribution in such extreme conditions, alongside fiscal and structural policies in restoring growth and achieving our inflation targets. Now, a final lesson that I must touch on is that very low interest rates and the unconventional monetary tools that can be deployed to enhance their effects, tend to create financial imbalances that can grow through time. These risks must be accepted should the downside risk to the economy lead to even worse outcomes if it was realized. But the dynamic effects of these growing financial imbalances on the future of the economy must be taken into account by policymakers, and that is a complex task indeed. Well, it's time for me to bring us back to the present and conclude. And in a world where many economies continue to resort to unconventional monetary policies, Canada's outlook is encouraging. The lower Canadian dollar and the interest rate actions taken earlier this year are working, and it will be some time before we see their full effect. The overall economy is growing again, even as the resource sector contends with lower prices. And that's because the non-resource sectors of the economy are gathering momentum. This is all taking longer than we imagined back in 2008. But our judgment is that our economy can get back to full capacity with inflation sustainably on target around mid-2017. Nous estimons que notre économie peut revenir à son plein potentiel et l'inflation à la cible de façon durable vers le milieu de 2017. And given this outlook, it may seem like an odd time for me to be updating our unconventional monetary policy toolkit. I certainly hope that we won't ever have to use these tools. But in an uncertain world, the central bank must be prepared for all eventualities. And we'll continue to watch how these policies work in other economies and adjust our own thinking at the Bank of Canada as appropriate. In short, should the need arise, we'll be ready. Thank you.
So the governor has kindly agreed to stay at the podium for a few more moments and entertain 2 or 3 questions. So I think we have a roving microphone, that young lady back there, Taylor. So if you have a question, please raise your hand and wait till you actually have the microphone to start asking the question, or we will not hear it up here.
What, did we agree that you would pay $1 for each question?
I guess. Should have raised it to 10.
Here, I think we have one.
Well, I'd like you to comment on the impact on savers of lower interest rates.
Well, it is a regrettable side effect that savers are also hit by these policies. I mean, the purpose of these policies, of course, is to offset a very negative shock to the economy, so that if we weren't playing defense against it, the outcome could be far worse for everybody, including savers. So that's an important thing to bear in mind. I have no qualms about saying that the actions that central banks and fiscal authorities took after this crisis, 2008 to 2010, in that period, prevented the second Great Depression. So savers would not be better off if we endured this, even if interest rates were a little higher. But the fact is that interest rates are low, and that people who are the savers, the retirees and those who are saving for retirement, bear part of this cost of us doing these policies. When it comes to countries that have used negative interest rates, don't forget that we're talking about the policy rate for the central bank. And behind that, there's a full financial system for both lending and for savings, which generally finds, that interest rates don't go below 0 for savers. And I would expect the same sort of behavior to happen here if that eventuality ever came. But that's all to say. That's not to minimize the issue. The issue is that interest income is low under these conditions. But again, I have to remind you that the situation could be much worse if interest rates weren't as low as they are. It's a good question. Worth at least $2.
Okay, another question. Oh, thank you. Way over here, Taylor.
Yeah, here comes the mic.
Yes, thank you. We've often heard that the kind of the unemployment rate for full employment is considered 4%, 5%, or whatever. Where does the 2% acceptable number for inflation come from? What's the basis of that number?
Well, the 2% inflation target was developed back in my first period at the bank, back in the 1980s, early 1990s. At the time, we were concerned that there was always a degree of measurement bias in inflation, that, you basically, everybody changes what they buy almost every week. And so the weights on the various bits of inflation change through time, and they get updated every once in a while. And when they get updated, inflation then is closer to the truth. But a more important issue to me is if you have 2% inflation, and if you think, let's say the equilibrium real rate of interest is around 2 or 3%, something like that, what that means is that when everything's steady, interest rates would be something like 4% at the short end, maybe even a little higher. And what that means is when there's a shock to the economy, you have a lot of room to cut rates in order to, cushion the blow to the economy. So the issue that this raises now is that we expect, as we go forward, because population growth is declining, the equilibrium growth rate will decline. And as that happens, the neutral rate of interest for the economy will also be declining. And so that means we could end up in a situation where with a 2% inflation target, say the equilibrium interest rate will be lower, say 3% as opposed to 4 or above. And that means we'll have less room to maneuver 10 years from now, let's say, if there were a big shock like we endured recently. And so that's one of the issues that is up for discussion, as this year we are aiming to renew our inflation agreement with the government, which will be about a year from now when we make that announcement. And that's why we're considering whether there are merits to raising the inflation target to a higher number to have more room to maneuver. But obviously, this discussion today informs that discussion too, which means that if interest rates can go below 0, you get a bit of room to maneuver on the other side. And so those things kind of all go together as an important question that you raise. The 2%, not arbitrary, it's just that no one thought that 0 made sense. So you pick 2 because it's low enough that it doesn't really matter. It's easy to remember. You ask people, what do you think inflation rate? If they haven't looked it up, they'll just still say 2% because they're used to it. It's been 20 years now. And so it has anchored expectations remarkably well for the past 20 years. So for us, it's a very high bar to change that in any way. We think it's got served us very well for the last 20 years. So, but that's a complicated question, actually. I could talk longer, but I should probably stop. There's some good stuff on our website if you're keen on that question.
Okay, we have another question right at the back here.
Right at the back.
Mr. Poloz, I read in the papers some years ago that Canadian corporations are banking a lot of money. They're not deploying their capital. Is there, in fact, an excess of capital in the world today? At one time, capital was rationed and it justified higher rates. But now they're so low. Right. Is that function of rationing capital gone?
Well, it's a great question, and it's a complicated one. But I think the consensus is that there is more savings in the world than there is investment going on. So that's part of the savings glut story. And of course, that's one of the reasons why equilibrium interest rates are lower today than they were, say, 10 years ago. But I think it goes a little deeper, which is that the reason companies have accumulated some cash is because of what they've been through. So what they've been through, if you're a company that was here 10 years ago, you know it's been a tough 10 years. And so what you've done is you've accumulated cash, and you may be ready to invest and grow your business, but you're not 100% certain yet, because every day there's something new that happens that makes the situation uncertain. So this goes to the animal spirits that I mentioned before. So if those animal spirits are cautious or reluctant to re-engage, the good news is that companies have the ability to begin expanding their businesses, and some already are, so that it won't be slow to start when it gets going. So we believe it's actually underway in many of the non-resource parts of the economy, led by stronger export demand. And it's going to take a little longer for it to become more unanimous, if you like. But throughout that period, we're going to see the resource sector still working hard to cope with those lower rates. So they won't be doing the investing. It'll be the rest of the companies. So I hope that goes part way to answering your question. As a whole, they do have the capacity to invest, which is very good news. And we just have to make sure the conditions are all right to foster that growth.
One last question, Governor?
Yes.
Okay, back here. Nope. Okay, I thought I saw someone back there.
I thought it's over there. I think.
Over there?
Yeah.
Okay.
Excuse me.
Just wondering what effect do you think the policies will have on the housing market in Canada?
Well, if we go back to the crisis, and my contention that if we hadn't done what we did, we would have had a very bad recession, if not a second global depression. Housing is the main thing that got boosted to offset that shock for us. So with low interest rates, people responded predictably. They were able to enter the housing market earlier than they ordinarily would have in their life cycle. And so the share of housing demand in the economy has risen quite a bit compared to its historical norm. And so the conditions that we face now continue to favor continued growth in the housing market. That, of course, has been the most important source of growth as we've gone through the last couple of years. As we go forward, what we're expecting and what we're actually seeing is export growth in the non-resource sector. Key sectors connected to the U.S. recovery are picking up speed quite dramatically. There's some great charts in the Monetary Policy Report from October which demonstrate this. So as they pick up, what will happen is the center of gravity for Canadian growth will shift away from housing, which probably has run most of its course, and as it kind of reaches a sustainable level, it's exports in the non-energy, non-resource sectors, which will come up and take its place. And we call that a rotation of demand, which is to say there's kind of a change in places of what is actually leading economic growth in Canada. And it will be our traditional growth track, which is exports.
Thank you very much, Governor.
Well, thank you very much, everybody.